The Indian stock market is in doldrums. Nifty and Sensex are seeing historic routs. Large, small, mid caps, no segment of the market is spared. In the last 1 week, investors lost a total wealth of 20 lakh crore rupees. 20 trillion rupees. That is more than the GDP of Greece and slightly less than that of New Zealand. Now, a lot of factors are leading to this battering. A constant exodus of foreign investors since October, a stronger US economy, weak corporate earnings in India, a long spate of overvaluation of stocks, and most recently, a spate of tariffs by Donald Trump that has led to a dark wave of uncertainty over global trade. We will try and explain all of this and more in today's episode with my colleague and ET's markets editor, Nishant Vasudevan. Listen on, it's Thursday, the 13th of February. I'm your host, Anirban Chaudhary. This is the Morning Brief. Hi Nishant, very warm welcome to the Morning Brief.
Hey, Anirban, thanks for having me on the show.
You have the dubious distinction of being a host on the show more times than being a guest, but it's always good to have you on either side.
Thanks, Anirban. Always a great pleasure to be on the other side.
Right. Busy days, lots of market news, most of it not good. I think we are seeing one of the longest spates of stock market drops in recent years. Let's start by you telling me how severe is this? And of course, what are the numbers showing?
The description is quite accurate. It is actually one of the longest drops, at least in the past 5 years. Now, to understand the severity of the entire situation, let me just give you a few numbers. Okay. See, the Sensex and the Nifty are down 12%. The small cap index is down 18%. This I'm talking from September 26, 2024. That was the spot when the entire this correction started. So since then, the Sensex and Nifty are down approximately 12%. Small cap index is down 18%. And the mid cap index is down 16%. But that does not really tell the entire story. Because beneath that surface, the damage is much more severe. For instance, there are 300 stocks that are down 40 to 80%. And then again, there are thousands of stocks that are down 20 to 40%. So why it is severe is that, this kind of a sell-off, I don't think anybody who's entered the markets after COVID, I don't think they have seen anything of that sort. And why it is also significant is because India is severely underperforming most of the other emerging markets and the developing markets. So barring Philippines, India is, let's say, the worst performer in the past, let's say, 5 months. China is up 11%. The US indices are up 5 to 8%. So the past 5 months, they have really tested the investors in India.
So, we used to be, one of the most favored till mid 2024, right? I mean, and Indian stocks are, as you're saying, some of the least favored now. So what really happened? And there is, of course, a huge FPI angle to this. Why don't you tell me about that?
Absolutely. The enormity of the FPI selling that has dragged the entire market down. But the FPI selling, okay, just to give you the numbers, they have sold almost 2.4 lakh crore in the secondary market, which is approximately $28 billion in the past 5 months. This is since September 26th. Okay, now that is huge. It has never ever happened in the history of Indian stock markets. But that only says one part of the entire picture. Now, why would FPI sell in this manner in India? Okay, so as you very rightly pointed out, India was among the most favored markets till mid 2024. See, Indian markets, the valuations as such were always a concern. They had reached uncomfortable levels, but still people were okay to kind of value India at a premium to several other markets because we had strong corporate earnings growth, which was, in the mid teens kind of a thing. Now, what happened all of a sudden? Now, we were always a valuable market, okay? Now, in September, China, which had been underperforming till then, it announced a stimulus. This was in September. Okay. Now, the moment China announced a stimulus, people sensed some kind of an alternative to India. Probably they thought that Chinese markets are beaten down. Now, let's all go to China. That is the point where the FPI selling started in the secondary market. But then it didn't end over there. The September quarter earnings, which came out in October, they were disappointing. Just to give you a number, the overall profit after tax, which has been growing for the past 7 quarters, which is almost 2 years, it actually contracted. It fell 3.6%. So the drop was the first time after 7 quarters. Now, that was a big shock to many investors because now till then you were saying that the Indian story is all about earnings growth and stuff like that. Now, actually, your profits are contracting. So then that is the time when the foreign outflow started accelerating. Another thing which has happened also is that the US economy, despite all the interest rate hikes, it continued to show very strong numbers.
Correct.
Okay. And then simultaneously, there was news of Donald Trump also coming back to power. The dollar strengthened over there. The US bond yields also started going up. So then a lot of foreign investors also started wondering why should we be in an emerging market which is not really growing, which is on the contrary, which is contracting a little bit. At the same time, when you have a top rated country like US which is growing at a very fast pace, the dollar is also strengthening over there, and also you have bond yields that are returning almost 4.5%. So it didn't make sense for a lot of foreign investors to stay back in India. And so since September 26th, they have been selling indiscriminately. And that is what we are seeing. The impact of that we are seeing on the domestic markets. Just to add one point over there, if it was not for the domestic flows, which is mainly from the domestic mutual funds, the overall numbers that we spoke about in the first question, it would have been much more severe.
Right.
So the domestic flows have actually has cushioned the fall to some extent.
You spoke about the US economy, and which obviously brings us to the latest factor that has impacted the markets, which is Donald Trump's executive decisions, his latest set of tariffs. And that's
Yeah.
hurting sentiments a lot. It's keeping markets very, very nervous. How much will it impact India? Has it already impacted India? And how do you see the impact panning out?
From an Indian economy point of view, the sense that we are getting is that the impact is limited. I'm talking about a direct impact because, Donald Trump's, the trade tariff plans, it is actually meant for countries like China, Mexico, Canada. Now, these are the ones that could be most impacted from a direct economic point of view. But how will this impact us will be more from a dollar movement point of view, or maybe from a sentiment point of view. We'll also be impacted. Donald Trump is going to use this tariffs as a negotiating point with all countries. That includes India. But the sense you get is that Trump is using a lot of it to just negotiate more than what he actually plans to do. But some of the countries that could be impacted more than the rest would be probably be China or maybe Mexico. From a markets point of view, if it keeps the global markets nervous, it will obviously impact the markets also. Every story or every event has a life. Once this event plays out, then markets will not be very, very worried about what Trump does or what, unless he does something bigger than what he's threatening to do on the trade tariff part.
Let's go to back to the Indian stocks now.
Yeah.
there were also concerns that many of the stocks were, overvalued. Now, do you think the market has corrected enough for the valuation concerns to ease, or do you see more correction happening?
Yeah. That's a very it's a valid question, because see, with valuations, the fact is that valuations as such, they don't trigger a market reversal, but they normally give you a warning that, listen, this particular market or this particular stock is overvalued or undervalued. So now, after the decline that we have seen in the past 5 months, a lot of the froth in the valuations, they have kind of they have been removed, split into three segments: large cap,
Hmm.
mid cap, and small cap. From a large cap point of view, because of the kind of selling that we have seen, a lot of that froth has subsided. The large caps are looking a lot more cheaply valued. They are looking a lot more appealing. If you look at the price to earnings ratio, which is a very widely followed valuation parameter, that has kind of come closer to the 10-year average, or it has kind of fallen slightly below the 10-year average, which basically shows that valuation among large caps, those have kind of eased quite a bit, and they are looking much better in terms of valuations. But now when we look at the smaller companies, the small and mid cap companies, the valuations over there, they are still much above the 10-year average, even despite all the correction.
Yeah,
uh,
you said
or
you talked about a 40 to 80%, even despite that, huh?
Despite that, many of the stocks are still trading above their averages. And yeah, there is still a fair bit of valuation concern in many of them. And that is the same point which ICICI Prudential's CIO S. Naren raised. He said that in a recent conference, where he
Mhm.
said that the appetite for small and mid cap stocks, they have not subsided. People are still doing a lot of sips in that. And that is where he warned that you can't do sip a systematic investment plan in an overvalued asset class. In that, he actually was alluding to small and mid cap stocks. So over there, his suggestion was that if at all you want to do a sip, you should go for large cap oriented schemes or large cap oriented stocks.
Now, how long do you think the market weakness will last?
Oof, that is a $1 billion question. It all depends on a few things. One is, of course, how long the FII selling will last. Now, nobody really has any idea of how long it will last, because it depends on several factors which are way beyond what we can think. Because after, a long period of FII selling, the flows have just, kind of reversed, and then they started buying. So
Hmm.
now, let's say in this case, it could be that foreign investors think that the selling in India is kind of excessive. We have sold enough in India. Now it's probably time to buy again. We think that valuations are a lot cheaper than what we were getting last year. That could be one factor. The other factor is that the corporate earnings growth, they are showing some kind of revival. Let's say that if the dollar weakens a lot, if the US Fed starts cutting interest rates much faster than what the market is perceiving, and the US bond yields also fall, that could also trigger some kind of a reversal. Or let's say that China is taking a bigger hit than what people are expecting. Probably, FIs will think that, that it is time to kind of, buy India. So it could just be about anything. The sense that we are getting when I talk to investors and brokers and other people is that probably this tentativeness could continue for maybe a couple of months more, but the second half of 2025 could be a lot better for Indian equities.
And my last question would be your last question that you usually ask your guests. What
Yeah.
should investors do at this juncture? And clearly, there would be different plans for the three different parts of the market that you sort of talked about: large, mid, and small caps. What should they do?
Absolutely. So as of now, the blind bet is obviously large caps. You could bet on the Sensex and Nifty. And how do you do that? You could stagger your purchases over the next few months, of next few weeks. You don't have to kind of buy everything at the moment. Let's say you have 100 rupees. You could buy 30, 30, 30 over the next, let's say 4, 5 or 6 months, or else you could buy 50 now and then spread the rest later. It all depends on how the indices behave over the next few months. If the fall is sharper from here, you could deploy the money faster. I'm specifically talking about Sensex and Nifty. And how do you do that? You could either buy, index funds, ETFs, or you could put money in flexi caps, which have larger exposure to large cap stocks. It is still not time to go big in small and mid caps
Mhm.
because of the reasons that we spoke about earlier, which
Correct.
is obviously valuations. Even if it is SIPs, you might want to keep the SIPs to the minimum and not go all out. The other thing that which a lot of investment advisors talk about is investing in multi-asset funds,
Sure.
which basically invest in, let's say, equities, debt, and gold. So, the fund manager has the discretion to decide where he or she wants to invest, and they kind of keep altering the ratio on the basis of how the markets are. So there are options. The basic idea is you should not stay away from the markets for too long. You should deploy in areas which are beaten down and stay away from areas where there is still a lot of froth.
Understood. On that note of very sound advice, we will wind up our discussion. Thank you so much, Nishant, for your time and your insights.
Thanks, Anirban, once again. Thank you for having me here.
That's it for today. This episode was produced by Vinay Joshi and sound designed by Amrit Reggie. The morning brief drops every Tuesday, Thursday, and Friday, wherever you get your podcasts. Keep listening.